everyone. Drew Creekmer, Wealth Advisor and Director of Advisory Services at Creekmer Wealth here today. And in today's flash briefing, we're going to have a little bit of everything. We're going to talk about some year-end things that you can do to help you achieve your goals as you move on into 2023 and provide some historical context and data points for you to keep in mind as you take a look at your investment allocation as you move into 2023. In the body of this email, there's a blog from our Director of Financial Planning laying out 3 key things that you can do to make sure that you're staying on track towards achieving your goals. And these are things like increasing the amount that you're putting in your 401k, making sure that you're using the right combination of retirement vehicles, and a few other things. And so I would encourage you to check out that blog from Andy. And a side note that I'll add there, this week, a bill was passed in Congress called the Secure Act 2.0. And there are some huge changes to the overall retirement planning and investment landscape in that bill. The bill included ways for people over the age of 50 to save more money in their retirement accounts, ways for people to get more money into Roth IRA or Roth 401k accounts, changes to the RMD age where you're required to take money out of your pre-tax investment accounts. And there's even a change that allows you to move money from an HSA that you've had for over 15 years and are not using for education purposes, moving those dollars into a Roth IRA. So there's a ton of changes and a ton of new ways for you to get money into investment accounts that are properly set up to help you achieve your retirement goals. So what I would tell you to do is if one of those items stuck out to you, maybe you're over the age of 50 or you're trying to figure out how to reduce your taxes in retirement because we know taxes are going up in 2026, give us a call. Our Director of Financial Planning, Andy Anderson, will be happy to walk through those questions with you and make sure that you are in the best place possible. Now, I want to shift gears real quick to kind of provide a recap of where we are at the end of 2022. As of today, the S&P 500 is down over 20%. The NASDAQ is down about 35%, and the U.S. aggregate bond index is down about 15% for the year. And so anytime a stock market is down over 20%, that is considered a bear market. So we will end the year squarely in bear market territory. Now, the thing that's really sticking out to us, though, is the fact that the U.S. aggregate bond index, which is all of the publicly traded bonds in America, is down about 15% this year. That correlation between stocks and bonds has not historically existed. You know, you've been told since you started investing that, hey, when stocks move down, bonds are flat or they move up a little bit. Well, that didn't happen this year because the Federal Reserve increased interest rates at the fastest pace in history. And they did this because they were trying to bring down inflation. Now, the conversation of whether this was a good decision or if they were behind the curve and should have done this sooner is a totally different topic that we don't need to get into today. However, the impact of the Federal Reserve raising interest rates at that fast pace caused bonds to have one of their worst years in history. Now, it's critical to realize that we are starting to see results. Inflation is starting to come down. Last month, we saw a decrease in core inflation, and it's expected that the Federal Reserve will increase rates again in January. Anything after January is on the table. We will see what happens with the economy. Right now, the underlying economic data is strong, but most people do believe we will enter a recession at some point in 2023. We expect companies to reduce their earning expectations at the end of this quarter, which generally is a sign that the economy is also slowing down. And so at some point in time, we will see if the Federal Reserve does pivot. Now, it's really important to keep this fact in mind, though. In the history of the stock market, there's only been 4 years or 4 times where in 2 sequential years, so back-to-back years, where the market was down in both of those years. It's only occurred 4 times in history. Now, it's entirely possible that we do see a negative year in the market in 23. However, the odds are much more strongly weighted towards us having some type of positive return in 2023. So we'll see if that plays out. Now, it's important with that information in mind to take a look at this chart. Now, you've probably seen this chart different places before, but it's the market cycle of emotions, or emojis is what this chart is called. Think about where your emotions are at when you think about the stock market, when you think about your investments. Most people that I talk to all over the country are closer to that bottom spot. Maybe they're feeling frustrated or angry or depressed, or maybe they've accepted the fact that we have a mess on our hands and we have to get inflation under control, and that's really bad for my investments. But it's important to recognize that if you're feeling those emotions, that generally is a sign that we are closer to the bottom in the market than we are to a larger slide occurring. Now, that doesn't mean that we may not have a few more 3 to 6, 3 to 9 months of market downside, but it does mean that the light is closer at the end of the tunnel. And so, what I would encourage you to do, if you are someone who is just starting out investing, or maybe you're in that retirement yellow zone where you're 3 to 5 years to retirement, I would encourage you to reach out to our planning team. They will do a portfolio analysis where they will be able to show you exactly how much risk you have in your current investment and portfolio and show you what your maximum upside potential is and what the downside potential is. And hey, if we have another year like 2022, what's the impact to you? Or if we have a 2008, how does that impact you? And that information, we don't charge for that analysis. We think it's just critical for everyone to be informed, to be able to make the best decisions that they can. So I would encourage you, take us up on that offer. Our planning team is ready and willing to do whatever they can to address questions about how to save more money for retirement or how to save money on taxes or to even take a look at your portfolio for you. And we don't charge anything for that initial work. So, guys, I hope you had a good holiday season and you're getting ready for 2023. If you have any questions about any of the topics I covered today, don't hesitate to reach out. Myself or Andy will be happy to speak with you and address any questions that you have about any of these items in today's video. So thanks for your time, guys, and we look forward to talking to you soon.